I want to quickly talk to you about how to get a mortgage with zero down. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you're all doing fantastic. I'm doing marvelous. If you were to ask me, if you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's convo, I want to discuss with you steps you can take to get a mortgage with zero down. Many potential home buyers wonder how much they will need to save in order to get a mortgage. But did you know it's possible to buy a home without a down payment? So, in today's conversation, we'll take a look at some options you have when you want to buy a home without a down payment. And let me first give you an overview here. So, as the name suggests, a zero down mortgage is really a home loan you can get without a down payment. A down payment is the first payment you make towards a home and is due when you close on your home loan. Lenders usually calculate your down payments as a percentage of the total amount you borrow, right? Let me give you an example. Let's say you buy a home for 250,000, and you have a 20% down payment. You'll bring 50 grand. In other words, 250,000 times 20%, you bring that to the table at closing. And lenders require a down payment because it lowers the risk that you won't pay your bills, right? They want to make sure you have skin in the game. And down payments are a major hurdle for many home buyers because it can take years to save up for a lump sum of cash. And so you can only get a mortgage with no down payment if you take out a government backed loan. And this is very important to understand. And government backed loans are insured by the federal government. In other words, the government, not your lender, foots the bill if you stop paying back your mortgage. And the government offers insured loans to people who need financial assistance to buy a home. This means that government backed loans are less risky for the lender and they can expand their usual loan criteria to people with riskier financial profiles. I'm speaking here about borrowers with no down payment. And there are currently some types of government-sponsored loan that allow you to buy a home without a down payment. You have, among those, you have the USDA loans and VA loans. And each loan has a specific set of criteria you need to meet in order to qualify for a zero down mortgage. And I will speak a little more, I will elaborate on this topic later on in the show. So you may want to get a government-backed FHA loan or conventional mortgage if you find out you don't actually meet the qualifications for a USDA loan or a VA loan, because both of those options would allow you to make a low down payment. I'm speaking here about the FHA loan or a conventional mortgage. So, what are the pros and cons of a zero down mortgage? It's important before you even think about getting a mortgage with zero down. Let's just go through the pros and cons here. One is a zero down payment mortgage, a good idea. For example, you want to reserve your savings for other expenses, such as closing costs or a home improvement. You want to leverage cash for investing instead of tying up money in a mortgage. You want to get into a home faster by not having to save 20% of the loan value. And you want to take advantage of the market's historically low interest rates instead of waiting to save and possibly missing out on a home. So those are legitimate reasons why a borrower may want to get a zero down payment mortgage. What about the cons? One is a zero down payment mortgage a bad idea. You can save on interest rates because your lender perceives less risk. Okay, so again, what I'm trying to see here is I want you to consider these reasons to make a down payment on your mortgage. You can save on interest rates because your lender perceives less risk. You can avoid paying a private mortgage insurance premium, the PMI. You can reduce your monthly payments. You can immediately have some equity in your home. The more you pay down your mortgage, the more your equity goes up. In general, the more you can actually put down on a home, the better the terms you can get on your loan and the less you will pay overall. You should expect to pay mortgage insurance until you reach 20% equity in your home, which could be a long time if you are starting at zero. So this is something that it's something you have to think about. What I'm trying to say here is that in this show, I will show you how to get a mortgage with zero down. But I first wanted to sort of lay lay a foundation for the conversation so you know the pros and cons of a zero down mortgage. Okay, and one thing I also want to say here is that the getting into a home without making a large down payment right at the beginning might sound attractive, but putting money down on the mortgage has its benefits because even a small down payment can save money because your monthly payments will cost less. You may lock in a lower interest rate and you could avoid paying private mortgage insurance or PMI. So, what are your options for a zero down mortgage? First, let's take a look. You have the USDA loans. So, as I said earlier, a USDA loan is backed by the United States Department of Agriculture. And the government offers USDA loans to encourage development in rural and suburban areas. And you can get a USDA loan with zero down. And those kind of loans have lower fees than other types of loans. Both you and your home must meet a few criteria to qualify for a USDA loan. First, your home must be in a rural or suburban area. So you want to check out the USDA's map of eligible areas to find out if your home qualifies. We're putting the map on the screen here along with the link to the SDA website. So on this map, anywhere outside of an orange zone qualifies as a rural area. And then in addition, your home cannot be a working farm. It must be a single family unit and you must live in the home as your primary residence. In other words, you can't use this for investment strategies. You will also need to meet a few financial requirements to qualify. The combined gross income in your household cannot be more than 115% of the median income of the county your home is in. Your debt to income ratio should not be higher than 45%, and you must have a FICO score of at least 640. All right, this is important to know. And your lender, and the thing here is that DTI is very important. Your debt to income ratio is the percentage that tells lenders how much money you spend versus how much money you have coming into your household. And you can calculate your DTI by adding up all your monthly minimum debt payments and actually dividing that by your monthly pre-tax income. Okay, this is very important. And DTI, it's important because it indicates the amount of risk that you will default on the loan. Besides USDA loans, you have VA loans. You may qualify for a VA loan if you are an active duty service member, member of the National Guard, veteran, or the spouse of a deceased veteran. And VA loans are backed by the Department of Veterans Affairs and are another option if you want to buy a home with no down payment. VA loans also allow you to pay a one-time VA funding fee that's 2.15% of your loan value in lieu of mortgage insurance. So in order to qualify for a VA loan though, you must meet any one of the following service requirements. You need to serve or you need to have served 90 consecutive days of active service during wartime, served 181 consecutive days of active service during peacetime, served for more than 6 years in the National Guard or Reserves, be the spouse of a service member who died in the line of duty or from a service-related disability. And in addition to service requirements, you should have a credit score of at least 640 to get a VA loan. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. I'm still speaking to you today about how to get a mortgage with zero down. And now let me give you options for a low money down payment. So the zero down payments are two. You have the USDA and the VA loans. Now let's talk about the possibilities you have if you are looking into a low money down mortgage. If you don't qualify for a USDA or VA loan, there are still ways that you can buy a home without spending years saving for down payments. You have conventional loans with PMI. You have home possible loans from Freddie Mac. You have FHA loans. And you have down payment assistance, the TPA. Let's talk about that. Let's first talk about the conventional loans. Many people believe that if they want to get a conventional loan, they need a 20% down payment. This is actually not true. Depending on your lender, you can get a loan with as little as 3% down. The confusion comes from the private mortgage insurance requirements. Your lender will require you to pay PMI as a condition of your loan if your down payment is less than 20% of the loan amount. And PMI is a type of insurance that protects your lender if you stop making payments on your loan. So no matter whether you're paying for it or not, PMI offers no benefit. As a result, most people want to cancel PMI as soon as possible. What about home possible loans from Freddie Mac? This is kind of cool too. If you have low to moderate income compared to others in your area, this is a great program to consider. And you need to have a 3% down payment and lower mortgage insurance options. You cannot earn more than 100% of the median income in your area to qualify. And unlike USDA loans, this stipulation only applies to the parties on the loan, not your entire household. What about FHA loans? And FHA loans, which you can get with as little as 3.5% down, are backed by the Federal Housing Administration and are loans for people who have low to moderate income. And FHA loans have fewer requirements than USDA and VA loans. And for these loans, you must plan to live in the property you are buying as your primary residence. You need to buy a home that meets livability standards and move in within 60 days of closing. And it's important to keep in mind that you will need to pay for mortgage insurance throughout the life of the loan if you have a down payment of less than 10%. Some people get an FHA loan, wait until they build 20% equity in their property, and then refinance to a conventional loan as a workaround, because this eliminates the lifetime mortgage insurance requirements. You can also explore down payment assistance (DPA), and this is basically cool. I will sort of elaborate about that very soon. But what I'm trying to say here is that if putting money down on a single on a house is a huge hurdle for you, but you can't qualify for a government-backed loan, a DPA might be the right solution for you. And speaking of DPAs, let's talk about them. Down payment assistance programs. How do down payment assistance programs work? Very simple. Those programs provide would-be homebuyers with money to cover some or all of a down payment, and some programs offer help with closing costs. And assistance can come from many sources, including government agencies and nonprofits, and it's not always well publicized. So you got to look for it. You got to search. You got to seek it. You got to really research. All right. And generally, down payment assistance takes one of three forms: down payment assistance grants, forgivable second mortgage programs, and matched savings programs. Okay, down payment assistance grants, forgivable second mortgage programs, and matched savings programs. And the thing here is that the down payment assistance grants, provide buyers with down payment and closing cost funds that don't have to be repaid until the home is sold. And just two examples are the National Home Buyers Fund and the PenFed Foundation's Dreammakers Military Heroes Fund. You also have the forgivable second mortgage program. So if you don't qualify for a down payment grant program, you could pursue a second mortgage that is forgiven after you meet certain requirements. And you might have to live in the home for a certain amount of time, for example. And for example, we have the State of New York Mortgage Agency offers a down payment assistance loan that can be used with the agency's mortgage program and charges no monthly payments. The loan is forgiven after 10 years unless you sell the home or refinance the mortgage before then. Then you have the matched savings programs. And savings deposited in these special accounts are matched by banks, perhaps partnered with nonprofits or government agencies. The whole idea here is to help aspiring buyers build their down payments. And for example, we've seen a very great example. You have Indiana's individual development accounts match at least $3 for every dollar consumers save. This is pretty cool. Citizen Bank, however, provides something slightly different with its home buyer savings account. So by saving at least $100 monthly for 36 months, you can earn a $1,000 credit towards closing costs on a Citizens Bank mortgage. So if you want to qualify for a down payment, assistance, it really there are a few things you have to think about. You want to look at your debt to income ratio, your credit score, military or veteran status, your employment in public service, whether you have completed a home buyer education program, and programs may also set limits on home prices and restrict property types. So what you want to do is you want to really research the DPA program you have in your area and look and go to their website to read more. And the thing here, once you actually find the down payment assistance program that you want, how do you actually apply? there are a few steps you need to take to improve your chances of getting the DPA approved. Explore down payment assistance program for your state. There are several programs in your state. You want to really explore the ones that are available in your state because each state has a housing finance agency or HFA that oversees the affordable housing needs of residents. You want to locate your state's HFA website using a directory from the National Council of State Housing Agencies, and you want to search the sites for home buyer programs. You also want to check the county or city programs. And Southern California's San Diego County, for example, provides eligible buyers in the city of La Mesa up to $70,000 in down payment assistance. Okay, and also you want to review program requirements and gather documents. So once you have selected a program that you like, you can collect the paperwork you will need for the application. So in addition to ID such as driver's license or social security card, you might need to provide pay stubs, bank statements, employment history, recent tax returns for the last maybe 2 to 3 years, and you need to submit a mortgage application with an approved lender. And you want to borrow from a lender that participates in the down payment assistance program you have chosen and is knowledgeable about it. Typically, the program website recommends lenders, or you can select your state from. We actually there are resources on the internet, and you can select the kind of state you have from the proper resources. And if you are approved from a mortgage, the lender will work with the program administrator to obtain the program funds. And turnaround times for this process vary, and it can delay closing. I want you to be aware of that. So what are the pros and cons of DPA programs, down payment assistance programs? The pros. The main advantage of down payment assistance is that it could help you buy a home if you don't have cash on hand for down payments. These programs can be a wonderful way to achieve the dream of home ownership, right? A grant is effectively free money, assuming you meet all of the program's requirements. What about the cons here? The trade-off is that mortgage programs with down payment assistance may charge higher interest rates than borrowers would pay otherwise. This is, if you really think about it, it's just dictated by the suppliers of the program, right? Because they're taking more risk, usually because the buyer has little or no skin in the game. So this is something you have to think about. Let me give you an example. Buyers who use the North Carolina Housing Finance Agency's loan program, for example, pay higher rates by opting for down payment assistance. This might mean paying not only a higher mortgage payments, but also more in interest over the life of the loan. Now, I just wanted to throw a little piece of information here in terms of mortgage options for bad credit. So obviously, people who are looking to get a mortgage with zero down might be in financial straits, or they're just saving for other stuff, or they might have bad credit. So if bad credit is stopping you from getting a mortgage, then there are things you can do, because credit plays a very important role in your ability to get a mortgage, right? This is logic. And here are two solutions if you are more concerned about your credit score than your down payment. If your credit score is between 500 and 580, think about FHA loans, because FHA loans aren't just great for people with a low down payment. They're also a viable option if you have a low credit score. All you need is a credit score of 580 to get an FHA loan combined with the lower down payments. However, you will have to make up for it with a larger down payment if your credit score is lower than 580. You may be able to get a loan with a credit score as low as 500 if you can bring a 10% down payment to closing. The minimum credit score with the Rocket Mortgage, for example, is 580. And if your credit score is under 500, this is very important. You'll need to raise your credit score if it's below 500, or you don't qualify for an FHA loan. Even if you can get a loan right now, there are plenty of benefits to applying for a loan with a higher score. A higher score gives you more lender choices, right? And access to lower interest rates. This is just cool here. An interest rate that's just a fraction of a percentage point lower can save you thousands of dollars over the course of your loan. So investing in your score is worth the effort. And let me give you a few tips to raise your credit score. Pay down your outstanding debt. You want to reduce the amount of money you put on your credit card each month. You want to always make your credit card and loan payments on schedule. You want to take out a small personal loan and pay it back. Apply for a secured credit card, which is a credit card that requires a deposit you will need to pay back in full. Remove any errors on your credit report, and you just want to rinse and repeat. Just want to repeat that process. And another question I want to actually address before we close today is a zero down or low money down loan right for you? The thing here is, if you meet the requirements and can qualify for a USDA, VA, FHA, or a home possible loan, not having to pay an enormous down payment is definitely an advantage. Okay? Especially if you still have to pay closing costs. And avoiding or reducing your down payments means you have savings to fall back on when emergency arises. This is a great thing to keep in mind if you are on the fence about your down payment strategy. It is not necessarily a better financial decision, though, to put more money down than less. Making the full 20% down payment and avoiding PMI is not ideal if it means emptying your savings account. So you want to take a closer look at your finances and make sure you explore all options before putting money down on a house. Okay? And so if you're in the process of buying a home, you know that many lenders prefer borrowers who can provide a 20% down payment. So this is something you have to think about. But again, there are a lot of options out there for no or low money down mortgages. Government-backed USD and VA loans, they allow you to buy a home with zero down, right? But if you want to put down 3.5%, you want to go for FHA loans, for example, or even the Freddie Mac's Home Possible program. So just food for thoughts. You just need to think about what really works for you, because at the end of the day, it's all about what works for you. All right, folks. Thank you so much for your attention in today's conversation. I was speaking to you about how to get a mortgage with zero down. Number one, I gave you the pros. I gave you the overview of the zero down mortgage program. I gave you the pros and cons of a zero down mortgage, options for a zero down mortgage, options for a low money down mortgage, down payment assistance programs, mortgage options for bad credit, and last but not the least, we just addressed the conversation. The question is a zero down or low money down loan right for you? Thank you so much for your attention. Really appreciate it. I'll see you next time. But until then, remember, stay marvelous.